Now we are going to dive into some forex terminologies. At the same time, we're going to be explaining some concepts, okay, so that you can understand how forex work. Now, the first one we're going to be talking about is cost, okay, cost, cost. What is cost in forex? Now, you must note that for each trade that you are taking, you have to pay for those trade. Okay, you pay for those trade. There's a cost. Okay, now the cost may come in form of spread or commission. Now these are the two major type of cost you pay. You pay cost for liquidity provider, and you pay cost for the broker for giving you the service to be able to trade. Liquidity provider for giving you ability to trade with bigger funds. So you see, there is a cost in placing a trade, but you don't have to worry because the cost is usually a small fee. A small fee. In fact, most forex traders don't even know that there is a cost. And the reason is because at the end of the day, if you are making profit, you won't even notice the cost or you won't even worry about it. Imagine you are closing a trade on $25 profits and then you saw a cost of minus 5 cents. It means that that trade would have been $25 5 cents profit. But because that 5 cents was taken as the cost, your profit was just $25. So does it really matter? $25 profit and 5 cents taken out of it. So it doesn't really matter. Okay, the fact that you would have made $25 5 cents, and not because the 5 cents was taken for the cost, it doesn't really matter. Now, even if that trade was to be a losing trade, it still would not matter because at the end of the day, you still lost this trade. The trade was a loss. So imagine that you are closing that trade on minus $25 5 cents. Okay, the loss is $25 5 cents. That is what you are losing. And you saw your cost. What is your cost? Minus 5 cents. It means that that loss originally would have just been $25 loss. But because the cost was 5 cents, that cost you will still pay for it. So the cost, your total loss would not be $25 plus the 5 cents that you lost, which is for the cost, okay, not loss. The 5 cents is a cost, okay? So it will not be $25 5 cents. Your $25 loss and the 5 cents what? Cost. So it doesn't really matter. Okay, so as you can see, the broker costs, okay, the broker cost most times is the spread. Now let me show you how the spread work. Okay, again, to place a trade, there is a cost for every trade you are placing. Now for the broker spread, as soon as you take a trade, that trade will you'll see it as loss. Why? Because the broker has taken that money from that trade. So therefore, you will need to make the spread first before your trade goes on profit. What do I mean? You place a trade, as soon as you place a trade, you see minus $5 loss. That is the spread that has been taken. Now, for you to make your profit, you must first make that $5 loss, make that $5, and then make your own profit now. So you are paying for the spread first before your trade goes on what? On profit. Going to pay for the trade first, for the loss first, okay, for that spread that you are seeing as minus 5. What it means is that it must go from minus 5 to minus 4, minus 4 to minus 3, minus 2, minus 1, minus 0. Aha! Then you cannot begin to make your plus 1 profit, plus 2 profit, plus 3 profits. Okay, so the broker spread, as soon as you place every trade, they will first show you minus 32 cents. So for you to be on profit, it must go from minus 32 to minus 31 to minus 20, minus 10, minus 5, minus 0, and then 0. And then $1 profit, $2 profit, $10 profit, $5, $50 profit, $200 profit. That is how it works. Let me show you on the phone. Okay. So this is USD JPY. Okay, as you can see, this is USD JPY. Now I want to take a buy trade. To take a buy trade, I'm going to click on this plus. Okay, this is MT4 I'm working with. So I'll click on buy trade. Okay, let's click on buy trade. Watch that. You're going to see instant loss first. Okay, instant minus something. That's to tell you that that's a spread commission. Okay, let's put our lot size to be 1.0. We'll buy. You see, minus 41. You see, minus 41. Okay, minus 0 0.4 minus 0.41. Okay, that was the spread. Let's do this again. Buy. You see, there must be a minus first. Let's go over this again. Buy. Okay, you see, minus 69, minus 0.69. Okay, that is the spread. So you see now we are making up for the spread. We've make up for the spread. So regardless, now if this is our entry point, for example, this is where we enter the markets entry. Okay, you know these are buy trades. Okay, we took a buy trade at this entry point. This is the entry point. Now the spread, let's divide this into two. This is for the spread commission. Okay, 0.49, for example, 0.49. So as soon as you take the buy trade like this, it will show you 0.49. It look as if you are starting from here. Okay, I don't know if you understand. Let me do this again. Okay, this is the entry point. Okay, entry point. Let's use entry point as a black line. This is the entry point, and we took a buy trade. Now, the moment we take a buy trade, they are going to, instead of the market to start from here, they're going to start from somewhere around here. Now, for the fact that we took a buy trade and the market is now down below, it means we are losing. That is why you see minus should be read minus 0.49, for example. So we took our buy trade from this point, from this level. But then because of spread will push the thing downward below that is starting from here. I don't know if you understand. 0.49. And then, but it's still recorded as your entry point. So for you to be on profit, the market will have to go up like this. Okay. Now it's not as if it's pushing your entry below. It just making it look like you start from here. Okay. But at the end of the day, what happened is the broker has put their money. So for you to make profits, now market may go down. Okay. Now markets may go down. Markets may go down. If markets go down, you may now begin to see minus, okay, minus 0.9. Okay, you see now it's bigger than the spread. So for you to go on profit again, market must go up. When it gets here, market begin to go on profit, and then you begin to make like $1. As you can see now, we're making $1. We're making $2. Okay, we're making $3. Okay, I didn't just take it straight. I did a little bit of analysis. If you check my phone now, you see I did a little bit of analysis. I'm currently in front of the laptop, and you can see that we have a buy signal. Okay, a buy signal, and that was why I took that trade. Okay, so you got a point now. So that's spread for you. So you see the market is kicking upward. We are making profit already. So you see that we have covered for the spread already, and now we are on profit. So does it really matter? Do you really know if we had some cost for that trade? Let's do a little bit of calculation. So you see now we have $2 here, $1. That's $4. Okay, plus this together, all this together will make it. This is okay. Let's get to understand this. Okay, it's going down, going down. Okay, see now $3. Okay, but the one thing you will see here is there's a little bit, you will not see that money there. Okay, there's a little bit of subtraction from that point, such that when we close the trade, you're going to see. Let's try and close this trade. Okay, we'll go to the history. Okay, so you see the cost here. You see the cost there. That is where you have the cost. So minus 0.30. Okay, let's close another trade. We are closing this trade on $62, $55, $41. So we close that on $41. Okay, so you see the cost is there. So we have already made up for those spread already. Okay, so when we are closing our trade on the profits, we are closing on profits 55.34. We close on $34 profits. Okay, I thought I saw. Okay, it closes on $55 profits. Okay, $55 profits. Finally, so you see the spread is there. That's the spread commission, but yet that money has been taken already. Okay, I will explain to you further. When we talk about spread, this is what we are talking about. I know some of you may not know what spread is. You see this? This is spread. So you see this is the bid price and this is the ask price. So the bid price is the selling price and the ask price is the buying price. You know, we say spread is the difference between the sell and the buying price, the difference between the bid price and the ask price in the quotes. So this is the quotes on the brokers platform. This is the selling and the buying price. So what's the difference? You see the difference is this is 00 and this is 01. So what's the difference? The difference is 1. Okay. So the spread is 1 spread or 1 point, or we can call it 1 pip. 1 pip. This is pip, PIPS. So it's 1 pip. Okay. So when we talk about spread, this is it. Okay, so I need you to understand what a spread when it comes to forex. So spread, as we say, is a difference between the ask price and the bid price, the buying price and the selling price. The bid price is the selling price, the ask price is the buying price. So this is the selling price, 1.3 thousand, and this is the buying price, 1.3 thousand one. Okay, so what's the difference between these two? The difference is 1. Okay, this is 0 and this is 1. So it will call it 1 pip or 1 point. Okay, so the difference is 1 pip, 1 point. Sometimes it may be 5 pips. Okay, so the broker may be charging you based on 5 pips or charging you based on 10 pips. Okay, the more smaller the spread, the more liquidity the currency have. So you have seen the video for the spread when we talk about spread, the video on MT4 when I demonstrate by taking trade. So you see what it simply means, spread cost, what it means is that imagine that you are having a 100-meter race and you are starting 1 meter behind the start line. You get the point. You are starting a 100-meter race, but you're going to start 1 meter. Okay, so you're going to go back far, not standing here. You're going to go far, far back behind the start line. You're going to go back 1 meter. So when the race starts, you are first going to run that 1 meter to the start line, and then before you continue the start line. Okay, that doesn't mean that you cannot win the race. You can still win the race. Okay, imagine even if it's a marathon race, even you still get to go back 1 meter before you guys all start the race. So some will win, some will not win the race. Okay, talking about spread, okay, I want you to understand this very well. Okay, spread can come in form of commission or in form of spread. Okay, the liquidity provider, we're going to talk about liquidity provider very soon. When they offer you liquidity to trade, they're going to charge you small amount of money. Okay, and when you're taking a trade with a broker, the broker, for them giving you that service, they're going to charge you some money, and you pay this money no matter whether the trade goes on profit or whether it goes on loss. So you can say that the cost or spread, these are standard fee, okay, standard fee that you are going to pay for placing a trade with the broker and for the liquidity provider providing you with the fund. That is just spread. It's cost. Just know it beside that you pay a cost. But most times you don't really take note of these things because if you're on profit. So we just mentioned a Forex terminology just now, which is called PIP or points. Okay, so that leads us to the terminology PIPS, PIPS. Okay, PIPS. What does it mean? Okay, so in Forex, this is the unit of measurement to express the change in value between two currency. I don't know if you get that. That is what we call PIP, the change in value. Okay, what is the current value? You used to hear that naira now is about 700 naira, and then naira now is about 800 naira. That is change in value. Now that change in value is measured, and the measurement is called PIP. Okay, the unit measurement is called what? PIP. Okay, so you can see the naira, say naira to dollar has moved 100 pips. Okay, 100 pips since last month. You get the point now. Okay. So again, the way you can understand PEEP, like we said, it is the unit of measurement. Now coming down here, you see that PEEP is the fourth unit after the decimal point, which is the smallest unit of an exchange rate. So this is the exchange rates. One, so we'll say the fourth unit after the decimal point. This is the decimal point. One, two, three, four. So we calculate PEEP with this one. Now, one, two, three, four. We calculate PEEP with this one. So what's the difference between this and this? That is the way we calculate PEEP. So the difference between this and this is what? Is one. So it's one PEEP of movement. If you don't get it right now. Again, PEEP is the smallest whole unit of measurement in Forex. Okay, I'm going to explain later further. And the size of PEEP is usually what? The fourth decimal place on the quotes. One, two, three, four. This is the PEEP. We calculate PEEP based on the fourth decimal points. Okay, now some brokers they have their quote showing 4 or 5 decimal place, which is to say after this one there's still another one. So we got to calculate based on the fifth one by then. It happens like that for some broker. How we have defined pips to be the smallest whole units of measurement in Forex, the unit of measurement in Forex. Okay, there is another way you can define PEEP. Okay, so you can say PEEP based on PIP is called percentage in points. Okay, now PEEP is how we determine the movement of the markets, because to be able to know whether you're on profits or to be able to know whether you're on loss, you have to first calculate how much as the markets move towards your direction. I don't know if you understand what I'm trying to say. For you to know whether the markets, okay, how much as the markets move towards your favor or how much as the markets move against you. So we're going to measure it based on PEEP. So the amount of time it moves towards your favor. If you see why PEEP is important in Forex, we need PEEP to be able to know how much price have moved towards our entry. So this is for stop loss and take profits. Okay, so you see this is a real trade where we took a buy trade there. Okay, this is a buy trade we took. This is the entry. Okay, this is the stop loss. With this level is the stop loss and this level is the take profit. So you see you can set your take profit and set your stop loss at the same time, and this is your entry. Now when price begins to go up, you see now this is the entry and this is the take profit. Let's say the take profit is this level. What's the difference between this price and this price? Becomes the PEEP. Okay, the difference between this price and this price becomes the PEEP. We are going to use to calculate how much profit we are making based on the lot. Emphasis sake, every movement in the financial markets is calculated based on what? On PEEP. So like this one we're talking about just now, price is 132,450. Price went up. If price goes up to this level, let's take this level 133,650. All you need to know the PEEP movements that occur is to subtract this amount from the this subtract this amount from the initial price. Okay, that will give you the difference. The difference will be about 120 pips. Now this 120 pips price move from here to here 120 pips. To different traders that took this trade at this point and close at this point, it's going to mean different amount of money. For some $10, for some $100, for some $500, depending on the lots they trade with. We have seen that PEEP is how you determine the movement in the market, and that would tell us how much profit somebody is making, how much loss a person is making based on the volume the person entered the trade. A lot of us will enter the trade with different volume, okay? But if we enter with the same volume, I will enter this at the same price and close at the same price, we're going to make the same profits. But if we enter with different volume, enter the same price, exit the same price, because the volume is different, the profit or loss will be different. So PEEP is the smallest unit of measurement in Forex. Just like if you are running a race, the smallest unit of measurement in a race would be what? Would be 1 meter. Okay, that will be the smallest unit of measurement. I ran 1 meter, I ran 2 meter, I ran 5 meter. The same way my trade went on 20 pips, 100 pips, 1,000 pips. measurements. For the notice, so that you just get to understand this, okay? Most times, all of these terminologies, some of these terminologies, you may not use them. For example, now, we say that PEEP is the fourth decimal point, so we'll call it PEEP. Now, what about, we say some broker will give you fifth decimal point. What about if you now have fifth decimal point? How do you call it? You call it pipette. Okay, I don't know how you want to pronounce this, but we'll call it pipette. Or you can call it one tenth of a pip. The fifth figure here, the fifth figure after the decimal point, you can call it one tenth of a pip. Okay, so let's move on to how you can calculate pip. Okay, now let us learn how to calculate pips. Okay, so if for example you have Euro USD as a currency pair and the price moved from 1.3719 and then it moves up to 1.3720. Now, how many pips? You can say that price move what? One pip. Why? Because the difference between these two is 1, 0.001 from 19 to what? 20. Now, what if price move from 1.5953 to 1.5950? Okay, what's the pip? What's the difference? This is 50, 53, this is 50. Obviously, the difference is 3. So the price move 3 pips. Okay, it's moved 3 pips. That is how you calculate pips. Okay, let's look at our pip will translate to profit for us. Okay, now if we take a buy trade at 1.28530 and then we close that trade at 1.28730, it is a buy trade. We expect price to go up. Now the price go up, yes, 285, 287. So the price went up actually. So are we going to close? Is this trade going to be on profits? Yes, price went up 20 pips. Okay, it means we are on profit. It was a buy, so it was a profit. Okay, because price went up 2853, 2857. Okay, 2873, 285. So 5, this is the difference. So there is a 20 pip profit. Now, what about if we take a set trade? Price is at or was at 1.28530. Now we close this sell trade at 1.28330. Now the price goes up or went down. Okay, this is the entry, this is the close. Let's detect on the price. 288. Okay, price went down from 53 to 58. Okay, so it means that price move or go down 20 pips. Price went down 20 pips. That means we're going to be on profits of about 20 pip. It was a sell. Okay, so since it was a sell, price came down, we're going to be on profits. So let's say we take a buy trade at 1.2853 and then we close the trade at 1.28330. Now the question is, did we close on loss or on profits? Now remember, since this is a buy trade, for us to be on profits, the market has to go up for us to be on profits. But you see now, there is a difference here. Market fell down to from 85 to 83. So market fell down. So what do you think would have happened? Market gone down 20 pips. Okay, 20 pips. So that means that we are on loss because we took a buy trade and market fell down. So we're going to lose that trade. We lost 20 pips. So later we're going to see how 20 pips is going to translate to dollars or pounds. What about if we took a set trade at 1.2853? So for a set trade, we expect price to what? To fall down. But yeah, we closed this sell trade at 1.287. Market went up from 5 to 7. So what do you think would happen to this trade? This sell trade. Okay, what would happen is that we took a sell trade and we lost 20 pips because markets went up 20 pips. So because market went up 20 pips, it means this is a losing trade. Now, we just talk about spread, commissions. Okay. Now, when are these money taken from your account? When are you charged these commissions, this spread? Now, when you place a trade, that fee, okay, that broker fee the liquidity fee is taken from you depending on whether you're taking a buy trade or whether you're taking a sell trade. And the price, the fee varies. There's a slight difference depending on whether it's a buy or whether it's a sell trade. Now, if you are taking a buy trade, as soon as you take the trade, then the fee is charged. Okay. But if you're taking a set trade, the fee is charged when you close that trade either on profit or on loss. So it doesn't matter. Okay, they are taking the charges at the beginning. Okay, regardless, if your trade goes on loss, that charges they will still take it because they have already fixed it. Okay, they will still take the charges. If your trade goes on loss, whether on a buy trade or a sell trade, their money is their money. Okay, that is how the broker make their money. They make their money from spread. Okay, from spread. That is how they make their money. So this broker that offers you this service, helping you to have access to the market, the way they make their money is by you trading. Okay, they don't charge you to open an account. Opening an account is free. So you have to make your deposits and then begin to trade. So as you trade, they make commissions based on spread. If you don't trade, they don't make money. Okay, so that is how the broker make money.